Dzień dobry, witam wszystkich Państwa zgromadzonych.
Good morning, ladies and gentlemen. I would like to welcome you, everybody present in this room and also everybody watching our transmission online. Welcome to the conference to present the LPP results for the first quarter of 2017. My name is Przemysław Lutkiewicz. I am the co-chairman for financial matters. And before we start with the presentation, I would like to tell you that for this year on, because this is a first presentation for 2017, so we've decided to change the presentation a bit. It is smaller, different layout, and as we have a smaller number of slides, it will take a shorter time, so I will present it myself. So let's move to the results and the slides. At the end of the first quarter, we've had almost 1,700 stores operating in 18 countries. The floor space increased by 7% and the sales in like-to-likes by almost 5%. The increases in e-commerce were very dynamic. The sales doubled, so exactly 100% more. And with that, we've had almost 1.4 billion sales revenues. So an increase. In this time, we have increased the number of our stores by 30, out of which the biggest amount, because 26 was in Sinsay's brand. This brand is developing most dynamically now. The offer that we have there, the offer plus price level, this gives an incentive for the brand to be also present there in the cities with lower number of people, so we can reach with this brand also smaller cities. What is also interesting to say, the Tallinder brand, now we have 0 stores, so in first quarter we totally closed all the stores of Tallinder. Here that means the countries where we have online stores. So now we have 6 countries selling online all of our brands. As you can see also in Poland, it has changed a little. We've had almost 1,000 stores at the end of fourth quarter. Now it is less than 1,000 because this first quarter, it's always the quarter where after a good December, companies change. On the one hand, we close the smaller stores, those not profitable, but we also close good stores for some modernization, lifting, etc. Also, this white field draws our attention. This is Belarus, but in 3 months, I will be able to have it in a different color. When we meet in 3 months, it will be green already, and that's because in April, we've opened our first stores in that country. Let's take a look at the sales. Left side, like-for-likes. But in this slide, we show 2 values. So like-for-likes, so increase in comparable stores. There you don't have online. And here on the right, you can see online. So what positive piece of information is that like-for-likes again had an increase, almost 5%, and I can tell you that all the brands and all the countries had an increase in like-for-likes in the first quarter. And if we take a look at online sales, then equal 100% year over year. And now online sales in the entire global value, that is 4% for the capital group, but for Poland only, because in Poland the online stores have been operating for the longest. Now we have 6% share. And that is the channel that increases most dynamically, and I will mention it later on during my presentation. And how was the sales by individual brands? Reserve, the top one on the left, is selling the most. 45% of our entire retail turnover, but what is also important is Sinsay, which is growing most dynamically, 27% increase year over year, but also Mojito. Mojito has almost reached crop when it comes to the turnover revenues. On the right, you can see the increase in floor space of each brand, and what is also positive is that the sales increases quicker for each branch than the floor space. That means that we have a positive like-for-like in each brand. And sales by countries or by regions, Poland, of course, the top one, contributes the most, 55% of overall revenues, but you can also see a dynamic increase in CIS, almost 40% increase. But here one remark. In Russia, the ruble has appreciated almost 30% year over year. So the appreciation of ruble, this is helping us a lot to increase those revenues. And also the table to the right, also floor space increase by regions, and also as in the former slide, sales for each region increases quicker than the floor space, so a positive like for each region. And again, total revenues, first quarter we've had 60% increase in sales, and here you can see sales per square meter. Sales per square meter increased by 9.5% year over year, average. And each of the region had increases, especially CIS, so Russia, Ukraine, this appreciation helped a lot. And so you can see that in Russia, we have more than 500 in sales. So this is more than in Poland. So again, we're back to 2012 when Russia was selling per square meter more than our domestic market. Let's move to the gross profit margin. The margin was flat year over year. It hasn't changed much, about 46% now and about 46% a year ago. Here in this graph, you can see that from the second quarter, we've had our new stock management policy. So that means that a year ago, we didn't have it yet. This new policy, that means that in those sale-off period months, so January, February now, we've had massive sell-off of old inventory to have as little stock as possible of the old inventories. And you can see that in the graph to the right. Here you can see that January, February, the value of the gross profit margin increased slightly, like 1% year over year, and from March, so March, and you can see that continues also in April, the margin increased by 8 percentage points year over year. That means in values that increases by 30%. And about costs, a few words. On the left side, costs of our own stores per square meters. The bottom one, rental cost, the middle part, gray part, this is personnel cost, and the top one, other costs, the increase per square meter by 12% year over year. So two comments here. On the one hand, please remember that the first quarter of 2016, that was the last quarter of a low base. This value, 191 zlotys per square meters. In subsequent quarters, it was already in excess of 200 zlotys, so the last quarter of low comparative base. And on the other hand, we also have the impact of ruble. If I had an exercise, what would be the increase of the cost if not for the appreciation of ruble by 30% year over year? Then the cost would increase by less than 8%. So you can see how much this piece of our Russian business, that means 20% of total, impacts our indices. And we've had the biggest increase in personnel cost. This is 22% of this cost year over year, and that is because now it is employees market. We must compete with other brands, with other companies to get employees. And it's not only in Poland. It has also started in the entire region. We talk about Romania, Czech Republic, Slovakia, the Baltic countries, even Russia. You can see that everywhere this demand for employees is increasing because business is developing, so the salaries are also increasing. Additionally, we also have in other costs 53%. This is 15% year over year, and this results, among others, from the fact that we've opened 3 new locations in Germany, and those initial costs. So they had an impact on this item. A few more words about the cost. If I took Poland only into account, so what would be the increase per square meter in Poland, then it would be only 4%, where I had a slight decrease in lease costs year over year, a slight increase in other costs, only 5%, and personnel costs, which increased by 18% for Poland. So it's less than average, but still we see that that was a major increase in this part. And also total SG&A costs per square meter. Here we have also both costs of stores and the headquarters, and again the lowest base for the last time, first quarter last year. And the increase for the headquarters, that involved the strengthening of our brands, employing a bigger number of designers, merchandisers, and trade people to have the best product possible. But also we invest a lot in e-commerce. And here we've also had massive personal increase costs in that area. And profit and loss account. At operational level, we've had a loss of 109 million, net 117 loss. That is more year over year. But the point is that the cost increased more than the revenues. That is because in February the margins were low, and from March it started to improve, and all the personal salaries increased. That started from January. But if we take a look at the March and the forecast for April, this higher margin improves our financial results, and we think that the second quarter should be really well. A few words about cash flow, or first maybe about the capital. The most important piece of the capital, this is our inventories, which increased in the first quarter in terms of real values because we've had new lines, spring, summer. But if we take a look above this line with the inventories per square meter, then it is less than 1,400 zloty. So this is quite low. So this is 15% lower than a year ago. So we now manage our inventories differently. We've got this new policy, and we focus a lot on this turnover and rotation of the inventories to have the lowest possible amount of inventories and to sell them as soon as possible. And this is performing well. And the second important element of the capital, we've shown it here in this graph. Here we show first quarter of the last year and first quarter of this year. So here you have stock with the receivables, and here you've got liabilities on the right. A year ago, it was 770 million zlotys, so that was the difference of our capital that we needed to involve. And here, if you take a look this year, that is material improvement, and this gap is about 400,000 lower. So we've managed to help with two things. One thing was the better inventory management policy, but on the other hand, we've also extended the payment terms to our contractors and suppliers. I've also had a question. What do the contractors say and our suppliers say about it? But the point is that not only we extend the terms of payment, but we also give something to them. Together with two banks, we've installed the banking platforms. The names for those platforms may vary. Some people say reverse factoring platforms, but also supplier financing platform. I think this is better. And such platform, so we post our invoices to such platform. The bank is sure if the invoices are approved, the bank is sure that that LPP will pay for the invoice. And on the other hand, the supplier may discount this invoice at a low rate, interest rate. The interest rate or discount rate is based on the financial standing of LPP and not the financial standing of the supplier concerned. And on the other hand, the supplier does not need to have any guarantees, mortgages, or anything else involved. He may simply use this platform, so he improves his liquidity and he also improves his creditability. So I would say that this is a triple win situation, because both for us and for the bank and for the supplier who increases his liquidity. So our objective is to have it in a long-term perspective, I hope within the next 2 years or maybe by the end of 2018. But our ambitious goal is to have the liabilities at the same level as our inventories, so to eliminate the capital gap that we require. So, and this cash, we use it to repay our debts to the banks. As you can see, the net debt is decreasing. In the first quarter, it was about 350 million zlotys, and the 0.8 rate that you have, so net debt to EBITDA, this increased as well because last year it was 1.3. So we are repaying our debts, and to the right, I also have shown you our capex. And this also involves this working on the trading capital to extend the payment terms. Here in the first quarter, we've had not that many openings of new stores, but the capex was high, 112 million zlotys. But the point is that we've shifted some payments for the stores opened in the third and fourth quarter of 2016 to the next quarter. So you can see the impact of extending the payment terms to contractors, including the contractors of construction services. To sum up the first quarter, we've had a massive increase of online sales. We've had optimization of our sales network involving, mostly in Polish market, involving this modernization of the best stores and closing the weak ones. The margin at the same level year-over-year with a positive outlook for the subsequent months, because March and April were much better in terms of sales, and increase in the turnover trading capital and the decrease in net debt. And what has happened? Important events in the last quarter. We've opened a new showroom in Warsaw, here in Chmielna Street. The new showroom is twice the floor space of the previous one, so we can present our lines much better, and we show them to fashion design bloggers, journalists, and everybody interested in fashion. Second event is opening 2 new stores in Germany, Hamburg and Köln, and both stores almost 3,000 square meters. And these are stores in main streets, commercial of those cities. First stores in Belarus, our 19th country where we have our stores. Here we have opened Reserved, Krop, and House in a shopping mall in Minsk. And we have some additional changes or improvement in our CSR. We've had a contract signed with a major company, British company, SGS, and this company audits factories in Bangladesh, and they are a well-established company, so the certificates of this company are approved by by everyone. So we have about 80 factories in Bangladesh that provide services to us, and all they have audits by Accord company and additionally SGS to make sure that the working conditions in those companies are in line with the corporate standards. You are aware that we've had 2 major design centers. That is, of course, Gdańsk with our headquarters, and here is where we design Reserved, Krop, and Sinsay, and Kraków, where we design for House and Mojito. But we also have a new design office in Warsaw. It's been operating not for a long time now, about 30 designers there. And we are very happy with their performance of these people, with their creativity. And we can see that here Warsaw gave us a lot, contributed like this fresh designer blood. These projects are already available, some of them in our stores. So we are looking forward, and we hope that this office will help our flagship brand to improve its results. Another slide about Germany. As I have mentioned, we've had the opening in first quarter in Hamburg and Köln, and today, on the 17th of May, we are opening our store in Berlin at the main street. There will be the official opening ceremony today, so this is our 19th store in Germany. Next year, we are also opening in Frankfurt, and then we will have a solid base of 20 stores. So in line with our plan, we've opened 20 stores in Germany and we are not planning to any other openings in Germany. We want these 20 reserved stores in Germany spread all over the country. We want them to be profitable, to be break-even. And then we will be thinking about further development in that country. And the development so far was as planned. And Belarus, 3 stores, so reserved Cropton House in one shopping mall. Here we are using a franchise model. These are not our own stores, but these openings of those stores, it was well perceived. At the beginning, people were even waiting in lines to buy, and the sales, it's twice higher now than what we've planned initially. So it is a very good start, a very strong start, and a good forecast for other stores. And we want to open 3 stores of each brand within the next 2 years in that country. What is important for us is to improve working conditions and safety conditions in Asia, especially Bangladesh. That's why we are working with international organizations. That's why we have hired this auditor company, and that's why we hired our own employees. That is 21 people working in our office in Dhaka, so the capital city of Bangladesh. So they are auditors to check the working conditions in those factories. And we can say that the 80 factories we're working with, they have really good work conditions. We've got photos from those locations, and we can see that is a good order, good level. And we really watch that, and we want it in terms of CSR perspectives. We want our company to progress, and we want the working conditions with our suppliers to be as good as possible. And let's move on to plans for 2017. So the increase in floor space should be about 11% year over year, so about 100,000 square meters to be opened in 2017. The majority, about 20%, of course, in Europe. So the EU, apart from Poland, plus CIS, so Russia, Ukraine. In Poland, we're slowing down. The development would be at about 3%, and that is not because we're opening less than we've planned like 3 months ago, but that is because we're closing those stores that are not performing that well, and that is our plan for Poland. And if we take a look here at this bottom side, development by brand. So here you can see that Sinsay is developing or increasing at the quickest rate, and then Reserved 14% year over year. Our objectives for this year were to open 4 new countries. Belarus already done. We also have an opening in Serbia and Kazakhstan planned for this year, and the UK. So a store in Oxford Street. And capex would be about 430 million zlotys, about 370 million for the stores themselves. E-commerce. 5 brands, so each brand has an online store in those 6 countries here. So that is the status as per the end of last year, and the plan for this year, first half of this year, that was to open online store for all 5 brands in the Baltic country, and this has already been done. Not long ago, all the stores went live, so now this plan has also been performed, and now we're working on an opening in the Ukraine and Russia. That is a major e-commerce market. And of course, we want to go live online with the UK before we open our flagship store in Oxford Street. The general business objectives for 2017, so what has been said 3 months ago is still valid. So first of all, increase in sales of like-for-likes, so positive like-for-likes. That the better line, the new collection, especially women collection, helps us. A lot has changed in these terms, that we can see that women are buying even more than they used to. If you say yes, but the women have always bought a lot of clothes, but yes, but now they are buying even more. And men like as if they stopped caring for fashion. So I don't know, gentlemen, what you're spending your money for, or it is women that are spending your savings for their clothes. So the point is that Mojito, Sinsei, in the women part of the Reserved are selling really well, margin. So again, our objective is still valid, that the margin for 2017 should be about 50 to 53%. It has not changed, plus the dollar depreciated, and we are happy to hear that. And another objective is to keep the net debt at a low level with the better management of the capital. The chances that we have ahead, and the chances that help to contribute are the dynamic development of e-commerce. We are opening online in new markets, plus better collections, which increase sales in like-for-likes, and risks. The risk, of course, still valid. A question mark, what about a ban on selling on Sundays, whether it will be valid or not? And of course, the question about Forex. So this is always very interesting for us. The last slide is dividend, because the management board has suggested, and on Monday, the supervisory board approved this proposal to allocate almost 65 million zlotys to distribution. And although the profit decreased, the dividend increases. So about 36 zlotys per share, depending on what with the warrants, which are still to be affected. And the dividend payment of the dividend in September, as last year and less in the former years. Thank you very much for your attention. That is all in this official presentation part. And now, if you have any questions, but of course, we've got online transmission. So if you have any questions, please say so and speak to the microphone. Please raise your hand if you have any question, and our colleagues will approach you with the microphone.
Niesamowite, ale nie ma pytań.
No questions? One question. Hello, Jakub Mann from PKO BP. Congratulations on this great management policy, capital management policy. We've seen those positive developments in terms of capital management, and as you said, this impacts the cash flow. So I wanted to ask whether these tendencies will continue in the subsequent quarters. Yes, thank you. We're working on it, and that was the beginning of our road, and our objective is to have the liabilities at the same level as the inventories, but we are going in the right direction. This extension of payment terms, this is increasing, and this is a long-term process. Maybe it will take about 2 years to reach the required levels, but what we're doing in cooperation with the bank, so this is very positive for the company. We are decreasing the frozen capital, and we're trying to decrease our liabilities. And the stock management is also important. This new policy, this new way how the stores are divided into categories, how we deliver to the stores, how we manage the inventories that were not sold, we move them for sell-off. So this impacts the capital really well. So we are continuing, but we already have some effects, so very well. Great to hear that, but can you also mention, because the depreciation of dollar, so can you say what would be the impact, the actual impact in terms of values if it continues in this year? For sure, yes. Each decrease in dollar rates is a good news for us. Unfortunately, it was quite late because we've already paid for the spring-summer collections, and now we're ordering and we're receiving the autumn collection, and the payments will be in the second half of the year. So it's a pity that it happened now, but it's still good to have a weaker dollar now, and it will impact our margins, and we hope that our margin next year will be better, next half will be better. This 52-53% margin is still achievable. Yes, we still have this objective. And can you tell us about the e-commerce strategy? Can you say something more how to do that, to increase that revenues on that? So first of all, the first step is to have as many stores as possible, to be in as many countries as possible. So we're rolling our solution, which is scalable, and we try to have it also in other countries. We have Baltic countries already, Russia, Ukraine, UK, to be soon, and we want to we would like to have online stores in every country where we have the regular stores. So the first thing is online marketing. We are investing in that marketing, and that online marketing is easy to calculate or measure. When we've been spending money or some like outdoor campaigns where you see in a bus stop or a big billboard on a building, it was difficult to say the impact of that expenditure in terms of return, how many customers came and bought due to those advertisements. And internet, everything is easy to measure. We know how much we spend, we know how much we earn. So this is value for its price. So the Google advertising and other advertising, it really has a positive impact, and it's important for us to have those online stores live in other countries, because we know that such period for such an online store to be fully operational, so it's like 6 months is the minimum. We need about a year for this customer to get used to this online store and to start buying. So the sooner we go live, so the better for this increase in the online sales. And the last question, not to take your time, a bit more about the Russian market. Could you say what's the situation there? The Russian market, it is selling very well in the first quarter. Now we've had a weird situation in March and April when we've had the new collection, spring-summer collection, but it's not a long time ago, like last days, it was still cold there. I've been to Russia and March, early April, and there was still snow in the streets. So in terms of sale, it wasn't well, but now it is really improving. So we also hope that it will go well. But performance in Russia in general is really well. On the one hand, the sales improve and Russia is profitable, and the appreciation of ruble also contributes. Thank you very much for your answers. Another question. I would like to ask about the Polish market. If you take a look about sales, so I think that this market determines others' market. Is it the problem of the market, or is it more like your problem? You mentioned restructuring, closing stores. How is the situation? So talking about the Polish market, it is true that the Polish market looks well, but the customer is a picky customer, because the customer has full access to online stores of our competition. So you need to put a lot of effort to satisfy the customer, the female customer, to be more precise, because if we take a look, then you can see that it is the female customer who is performing. And if we take a look at e-commerce, according to our statistics, 84% in the entire online standard, so that is women. And I was shocked recently that even in the on the male part, the majority of buyers are also women. So 60% of persons buying clothes for men are also women. So you can see how much effort you need to put to satisfy those requirements of ladies. That's why we produce in Poland Mojito, Reserved, produce as much as possible in Poland to have fashion available as soon as possible, top quality. And we also check what we could do to increase the share of Polish production. And the other thing is that if we take a look at our sales network, 1,000 stores in Poland, and you can see that with the current development of online and this cannibalism that is developing, so this selling goes online, so we can see that this 1,000 stores, that might be too much now. So we are working on it, that if some lease agreements terminate in line with the schedule, so we are thinking twice or even 3 times whether we actually do need these stores, because maybe we don't. So now we're trying to optimize our selling network. on the one hand, to close the smaller stores that don't perform that well, and on the other hand, we open and we increase the floor space in the good ones, in the good shopping malls like in Warsaw. We are waiting, and we will be opening a Reserved in Złote Tarasy. We are increasing or expanding the store in Arkadia and Złote Tarasy. So these are the good shopping malls where you still have this traffic. There are no problems there, and in places like that, we want to expand. So if you take a look at our development plan for Poland for this year, so we've had a decrease in the number of stores, but the floor space increased. So this is this quality improvement. So this is the Polish market now. Do you think that it is possible that in the next 2 or 3 years the floor space in Poland will decrease? I cannot answer these questions because we don't have such plans. Well, we haven't been talking or thinking whether it is actually true that the floor space will decrease. But you cannot exclude such an option. But as per today, so again, quality more important than the number of stores. One more question. Last year, we've been talking about restructuring of the Reserved brand from the point of view of your operations. Are you satisfied with this restructuring process, and is it over, and are the effects what you expected? Yes, it was a major effect in 2016, so improving or strengthening the product divisions of Reserved, so opening this new design office in Warsaw. Yes, we are satisfied with what we've done, with the effort that we've made, and we can already see some effects. We need to wait for some other effects, but the idea itself and the development, so we think it is positive, and we hope we now need some more time for the new divisions, for the new teams to work with each other, so that this information from the customer stores to reach those product departments even sooner to provide even better collections. But in general, we are very happy with what we've done. So the majority of development, you can already see it in your financial terms. If we take a look at the spring collection, so this is the one, we are happy. And we see a development already in terms of margin, because you can see that these collections, they have better margins. We don't need to depreciate those collections. We can sell with a higher margin, so this is positive. Of course, we are waiting for like full effects of all those developments and changes, and I think that the months to come will show that this development was a positive one, a good one, and we hope that it will perform even better in the next months to come. I have only one question about salaries. What we've seen in the first quarter, so the 63 zlotys per square meter in terms of salaries. So is it already the end of the pressure in terms of salaries, or is there still a risk that it will be necessary to increase salaries any further? I think that the majority of this pressure, that it has already been done in the first quarter, because all the increases in all countries, in all brands, that was forecasted and done in the first quarter. So I think, yes, of course, there might be some surprises, but from our point of view, as we have planned to do it and as we have done that, that should be milder this year. What we're still focusing on is a better management, personal management. That means the working hours in the store. So we're trying to do a fine-tuning of those working hours with our employees. So we try to adjust the number of employees to the traffic and to simplify operations at a store, so that the employee has more time to work with the customer without dealing with some administration stuff. So we see that there's still some room for improvement in this area. We can increase our efficiency of our staff in the stores, but the majority has already been done. Thank you. Anybody else? Any other questions? Some online question. We've got some questions from an online listener. What can we expect in terms of the general market? When do you assume the break-even will come? I've already had a meeting with journalists, and the same question was asked. What about the German market? When can you expect a break-even there? And my answer was, when we were entering the German market, we were a bit too optimistic to hope to have a break-even there. Now we've done our lesson, and we see that our major competition in that market, they needed 7 to 8 years to reach the break-even. And I said that I think that probably we need to have the same, about 7 or 8 years. But then after the conference, I've seen the press releases that we as LPP expect a break even in 2021, 2022. I haven't said it directly, but I would say that from this, my statement, you could assume that we would need about 7 to 8 years. So if we start at 2015, so 15, 16, 17, 18, 20, 21, so 22. So we hope that that will be the break-even, and we will be able to develop in Germany at a different level, both in financial terms and other terms of our satisfaction from that business. One more question. I would like to ask about those German operations. What are you planning to do there to have this break-even? So directly waiting, or is there any potential to increase sales through marketing or maybe some cost reduction? The majority of stores in Germany, well, maybe not the majority, but let's say 50-50, but the last stores to be opened in Germany, Köln, Hamburg, Berlin, Frankfurt as well. So that were street stores, so the costs, operating costs there are quite high, in particular lease costs. And we are working on the personnel to optimize those costs. But on the other hand, what we need is mostly time, some marketing and time again. We need more time for our brand to reach this German customer, to be recognized by the German customer, because we see that the customers that do come to the stores, the basket is bigger than of a Polish customer. They pay more than the Polish customer. So in terms of how much a German customer sells, we are happy, and this is as we've planned, but we still lack traffic, so we still need recognition of our brand so that more customers come in. Sometimes we have a store like door-to-door with our competition, and there they have twice as much traffic. And we believe that what we lack, this is more brand recognition. So to be there, to show yourself in terms of marketing. Marketing, I mean more like online marketing, social media, and of course, to be there with a good reserved collection. So what we're doing in our product department, we are improving our collections. We give more diversity for the customer. So that should be the key of how to improve our performance in the German market. Second question, management costs. You mentioned the new design office, the increased audit cost, new headquarters, and how those SG&A costs will impact in this year. So these costs increased in the entire last year. I mean, increasing staff number and those product departments and sales departments for every brand. So this work has already been done. And that's how you can see that this cost increased in the first quarter of this year in comparison to the last year. But as the majority of work has already been done, we don't see such a pressure, cost pressure at our headquarters. So the only cost that may increase still dynamically, so that would be e-commerce. But this is fully reasonable and fully legitimate. So in the subsequent quarters, we would expect our cost per square meter to increase at a slower rate. So not a dozen%, but a few percent. Ruble has quite an impact, but still it would be about 7, 8, or 9% year over year. So this is how I see it. One more question. If I may come back to the e-commerce, could you say Why such an increase? We see that this increase is accelerating. So what happened that e-commerce started performing better? Two things happened. They did not happen on their own, but we did two things with our effort and a lot of work. So on the first hand, so we made sure that the e-commerce warehouse gets goods quicker than the regular stores. So we have enough photographers. As soon as the new deliveries come, new models come, so they make photos and it is posted online as soon as possible. So the online customer can see the new models quicker than the customer of a regular store. The second thing is that the increase in the volumes in our e-commerce warehouses, because we have a separate warehouse for e-commerce and separate warehouse for regular stores. And it has been done on purpose because this is totally different type of work and packing. So again, we've had situations that we've had some shortages online, like, for example, a particular size of a particular blouse. We've had S and M, and we didn't have any L size. Somebody wanted to buy the L size, but it was not there. And now we make sure to have full variety in this e-commerce store, plus additionally the marketing, online marketing. So I would say we've done simple things. So we have made improvements for this bottleneck of the marketing. So we need goods quick, full size, nicely shown, plus also this involves the work of our photographers and web designers, because now a lot of people buy from their smartphones. So now our websites perform well on smartphones. But the photos are nicer. You can also see our models from different angles, plus descriptions of the goods. So this offer that we show online, it is much better now, much fuller now, and as you see, the effects are already there. Thank you very much. Ladies and gentlemen, I don't see any other questions in that case. Thank you very much for your attendance, and I will see you in 3 months. Thank you very much.